Okay, good afternoon and welcome back, everyone. Thank you for joining us. Hope everyone's having a great Thursday. Welcome back. My name is Tony Zhang. I'm the Chief Strategist here at Options Play. And today we have a slightly different topic. We're going to talk about entering option orders and managing your positions. This is a bit of a departure from our normal webinars where we talk specifically about trading strategies and how to go about utilizing different strategies for trading. Today, we're going to talk more about the mechanics of trading, which is just as important and many times not really often spoken about at many of these educational events with respect to options trading. And I think part of it is because of educators like myself. We sometimes take the basics for granted. So today, what we really want to do is go over the best practices for entering orders and answer the questions that sometimes beginners may feel a little too shy about asking, the very, very basic questions about how to enter option orders. I just had a user submit a question just last week where they made a mistake on entering their option orders and ended up with double the position they intended to have when they were trying to close out a position. So these are some of the things, like I said, that sometimes traders like myself, we take these basics for granted. So we want to make sure that we go over how to enter option orders correctly and appropriately for those of you that are starting out. And then for those of you that have started trading some options, we want to address some of the concerns around how to manage different option positions. So we'll talk a little bit about the different types of option strategies you may find yourself in. What are the general best practices for managing each one? I'll talk a little bit about my philosophy on risk taking and repairing trades, because I get a lot of questions about, how do I come back from a losing trade, or what do I do on a profitable trade? How do I take profits? So we'll talk about some of the rules that you can apply, or some of the techniques that you can apply to roll an existing trade and take partial profits and lock in profits, and reduce the overall risk of individual trades. So those are some of the things we're going to go over here today. As always, this webinar is recorded. So for those of you that are brand new, you can follow along with a copy of the slides after we finish here today at your own pace. So let's go ahead and get started. Now, before I do, just a quick reminder for those of you that are brand new to Options Play, welcome. You do have a free 30-day trial to the tools that I'll show you here today. But if you do not have access to it, you can sign up through the link I just sent everyone in the chat window here today. And this will give you access to a free 12-step options trading course for those of you that are brand new. That'll help jumpstart your options trading experience. And for those of you that are already members, you can still sign up at that link and get access to the course as well. And this gives you access to our platform, daily trading ideas, and options education like the one that you're on here today. So I hope to see those of you sign up for this and have access to that course and jumpstart your options education. So let's go ahead and get started. These are the things that I want to go over here today. I will try to spend as much time as possible going through things in detail. So we're going to start off by talking about just entering and closing option orders. We talk about trades a lot. We talk about different trades that we would make or show you how to make different trades, but we never really talk about the mechanics of entering that trade into your broker's platform. So today I want to break that down and make sure everyone understands it. For those of you that have been trading for a while, this may be repetitive, or this may be, you already know this stuff, but I think what is going to be important for those of you that are already trading is what I'm going to talk about with respect to pricing and liquidity. This is also something that traders like myself sometimes, having years of trading experience just comes naturally to us, may not be always apparent. So I want to address understanding options liquidity and understanding how to place your orders, or where to place your orders, more importantly. And then what we'll do is we'll talk about managing those positions. Once you're in those positions, what are the different ways that you should look at those positions to decide when it's time to cut those losses? When should you potentially double down on a trade or try to repair that trade? And then more importantly, when you're profitable on a trade, how do you lock in those profits, or how do you continue to take a trade but reduce the overall risk of that trade by rolling that trade? So those are some of the things we're going to go over here today. So let's first start off by talking about just entering an options order. So a lot of times during our webinars, we talk about different option strategies. When should you use them? What are the best practices for those individual strategies? So once you have a specific strategy in mind and you're ready to place that order, let's talk a little bit about how to enter that order appropriately. So first, every single order entry originates with first establishing some kind of view on an underlying stock or ETF. Whether you have a bullish, bearish, or neutral view on that underlying stock, you must first have that directional view, and that directional view will help you determine, number one, what option strategy do you want to trade, and then more importantly, what are the expirations and strike prices you want to use for that option strategy. So those are the first two steps that is required to open an options trade. Now, for those of you that are brand new, I highly recommend you to take a look at some of our webinars that we have produced on different strategies and understanding what strategies make sense, what are best practices for expirations and strike prices. But once you have all those things lined up, how do you actually enter them? So first of all, you want to make sure that whenever you're entering a position, you always start off with a to open order. So unlike stock orders where you simply just buy or sell, with options, you have to buy or sell either to open or to close. So whenever we're talking about starting a position, you have to make sure you're using a to open order. And you can place this either with a limit or a market order. So those are your choices here. So right off the bat, you'll notice that when you're trading options, there are a lot more parameters to keep in mind, and that this is what I think is confusing for sometimes for beginners, is the sheer number of things that you have to look at. Especially if you're looking at multi-leg options, you have sometimes 12 things to enter into an order ticket, and that can be daunting for a lot of beginners. So that's why we really want to make sure we walk everyone through this process and make sure that you understand how to go about placing this order. Now, an exit strategy. This is really where you have to set rules for yourself to determine when you want to get out. But most importantly, what you want to generally do is have a sense for when you're going to cut losses on a trade, and basically understand that when you're going to either cut losses or take profits on your trade. And these should all be based on rule-based approaches. And those are some of the things we're going to go over here today, is what are those rules for determining when to cut losses and when to take profits. So just for an example, we talk a lot about trading vertical spreads, whether you're trading a debit spread or a credit spread here at Options Play. What you generally get when you're using a tool like Options Play is a set of parameters that allow you to enter a trade into your broker's platform. Now, for multi-leg orders, you always want to make sure you enter everything as a single strategy. You don't want to enter multi-leg trades as two separate legs. So here's an example of a multi-leg trade that you want to trade. So here I have an example of a vertical spread that we're trading. So because this is an open strategy, what we do is we provide you with the details for each individual leg. We'll tell you whether the action is buy to open or sell to open, the quantity, the expiration date, the strike price, whether it's a call or a put, and the premium of that call or put. And then for multi-leg orders, you will have two legs. One will be a buy to open, and the second will be a sell to open. You will also have a quantity, an expiration date, a strike price, call put, and a premium. So as you can see, there's a lot of parameters that you have to consider when you're entering even a single leg order. And when you go into multi-leg orders, it just magnifies the number of parameters that you have to enter, which is why it's so important to make sure you understand these parameters correctly. So I want to make sure that everyone understands that when you're using a platform like Options Play, regardless of what strategy you look at, or whatever strategy you're trying to trade using Options Play, you can always hit the trade button and see exactly how to enter a trade into your platform. We provide this details for you right here at the top of your order ticket, so that you have all those parameters I just showed you here before, which are the 4 parameters right here that you need to enter into your broker's platform. And you want to make sure that you enter it exactly the way we presented here, so that you are trading the exact same strategy. Though that's really important for those of you that are brand new to options trading, is to enter these trades exactly the way we presented, so that you end up trading the trade that you intended to trade, or the trade that you analyzed using Options Play. So that is one way that you can utilize You could utilize options play to help you make sure that you are entering your orders correctly. But again, keep in mind that when you're entering a to open order, you want to make sure that that is an entry order. So when we're talking about entering and closing orders, this is really where you have two possible actions to enter an order and two possible actions to exit an order. So to enter, you have two options. You can either buy to open or you can sell to open. So those are your two options when you're entering an options order. And keep in mind that to get yourself out of those trades, you simply have to do the exact opposite, but to close. So if you open an order if you buy to open an order, then in order to close out that position, you're going to have to sell to close. And vice versa, if you sell to open, you're going to have to buy to close in order to close out that position. And that's the distinction that I think is sometimes difficult for stock traders, is you think that if I buy a stock, I just have to sell it to get out of it. Here, you can buy that stock, buy an option, but if you instead accidentally enter that order to sell to open instead, what you end up with is effectively the opposite order, but you haven't closed out your position. So that sometimes is confusing for beginners, and that's what I really want to make sure you understand, that when you're trying to open a position, you always make sure you use a to open order. When you're closing a position, you always want to make sure you use a to close order. So again here, if I have a bullish view on Apple and I'm looking to buy a call option, these are the parameters that I want to follow and enter that exactly into my broker's platform. Now, I will say that most platforms, when you're analyzing a trade off of an option chain or analyzing a trade using some kind of analyzer, you usually, most brokers will pre-fill a ticket for you. So all you have to do is click on the option, and your broker typically will already pre-fill that ticket for you. So if I'm trying to trade this Apple September 210 calls, it usually will pre-populate all of these parameters for me. So it'll already have this is on Goldman. This is buying 10 contracts of the September 210 calls. As you can see, it'll even pre-fill a limit price for me. And this is what I'll talk about next, is how to actually place your limit orders, or where to place your limit orders, which is, I think, sometimes also a very important exercise. But most brokers' platform will pre-fill a ticket for you off of an option chain. But if it doesn't, our tools will provide you with with the different parameters that you need to enter onto that order ticket in order to make sure that you're trading the exact same trade that you're analyzing using options play. So now that we've talked about how to enter that order, let's talk a little bit about pricing, because with options, you're going to notice that unlike a stock price where the bid and ask price of the stock is usually no more than a penny wide, but with options, many times it could be 10 cents, 20 cents, even a few dollars wide. And because options typically have much larger bid-ask spreads than stocks. So when you're talking about stocks that are large cap stocks and stocks that are less volatile, we'll typically see spreads that are relatively small. And what I mean by relatively small is, as you can see here, I have a spread of 775 by 795. That's a spread of about 20 cents. Versus sometimes when you're trading a small cap stock or a stock that has a lot of volatility, you might see a much wider spread, like $9 by $12.50, a $3.50 wide spread. And a lot of times this is confusing for beginners because you're not sure why you see these very large spreads, and you're not really sure where to place your orders. And that's really one of the things that we want to go over here today, is based on these types of spreads, where do you reasonably place a limit order so that you can get executed on your trades? And that's something that I want to talk a little bit about and address the concept of options, liquidity, and orders, because I get a lot of questions from users when they're placing an option order, and they'll say, hey, I'm looking at the trade that you recommended, or I'm looking at a trade that I'm interested in trading, and I notice that the spreads are really wide, or I notice that the open interest and volumes are really low. And this is something that we generally see outside of the top 100 names. And when I say top 100 names, I'm referring to the top 100 names by market cap. So if you look at any, which if you think about outside of the top 100 names, that means 400 names out of the S&P 500, which we typically think of as very liquid, fall into this category where many times you have lower open interests and volumes with wider bid-ask spreads. And what I want to address is the fact that if you think about the liquidity of an option, it's really tied to the liquidity of the stock. You don't want to think about just looking at open interest and volume or even just the bid-ask spreads to determine liquidity, because many times you will find that very liquid stocks just don't have a lot of options that are traded on it. The other reason that we notice that this lower open interest and wider bid-ask spreads comes out of the fact that over the last few years, we've started to list so many more strikes for trading. If any of you have noticed that when you trade options now, across the 4,000 symbols that we have options to trade on, there are now almost 1 million options you can trade across those 4,000 names. So naturally, volume and open interest will pool around the at-the-money strikes, and they typically pool around the round numbers. So even if you look at something like SPY, that's one of the most liquid names in the world, you'll see that there's plenty of options where the open interest will simply pool around the round numbers. So when we look at SPY here, as you can see, there's only 300 contracts available at 292.5, but 13,000 on the 292s. So just for some reason, people don't like to trade that 292.5, but it's not any less liquid than the 292s. So keep in mind that open interest is not by any means an indication of liquidity. So this 312.5 only has 19 contracts traded on it, just because people like to trade round numbers. It's not any less liquid than anything else. So keep that in mind when you're trading these options, is that open interest and volume is not always indicative of liquidity. So especially when you go to some of the less traded names, as you can see, you might have sometimes just 8 contracts next to 2,951 contracts, or 0 contracts here versus 2,951 contracts. But this zero contract call is not any less liquid than the contract that has 2,900 open orders on. So keep that in mind, that when you're placing your limit orders for different option strategies. And one of the things that we want to look at typically is not how wide the spread is or how low the open interest. We want to take a look at where things are actually filled. So many of you can use platforms like Thinkorswim, and you can actually see where orders are filled. There's a thing called option times and sales. You can actually see where things are filled. So when we look at something like, here's a 100 contract trade on the August 252.5 calls. It was traded at 122 when the market was at 120 by 135. So as you can see, 100 contracts were traded inside of the spread. And many times you'll see these large orders get filled at the midpoint. So here's a 70 contract trade that got filled at $8.20 when the market was trading at 810 by 830. So at the midpoint. So what we notice is that most trades, if you're willing to interact with the quote and you're willing to place a limit order inside the quote, most of them get filled within 5 cents of the midpoint. 5 to 10 cents of the midpoint is what we see. And I'm talking about very large orders. I was looking at some orders today on, I think it was Visa or Tesla, that were traded a few thousand contracts. And I noticed that most of them were able to get filled well within the spread. So here's 500 contracts that were traded, or 1,000 contracts traded at 134 when the market was at 131 by 136. So there's a trade here that was traded just a penny off of the midpoint for 1,000 contracts. So especially for retail orders where you're trading 10, 20, maybe 50 contracts, you should many times see executions well inside the spread, and no matter how wide the spread you're seeing on your screen, even if the spread is $3 wide, don't be afraid to place your limit orders inside that bid-ask spread. And I usually tell users to start 5 to 10 cents around the midpoint as your starting point when you're placing your limit orders. And that works the same regardless of what type of orders you're trading. For those of you that are more experienced with trading, you might also play around with market orders. There's a process for executing market orders in options that don't exist elsewhere. that allow market makers to effectively compete for your order once you establish a market order. And that many times gives you price improvement that may actually give you better fills than placing a limit order. But the best way to test that out is just with a couple of contracts at a time. But for most users that are starting out, I recommend that you start with limit orders. Again, start with about 5 to 10 cents around the midpoint. That's usually a good starting point for a limit order. So now let's talk a little bit about where to place that limit order, because it differs whether you're buying or selling. So again, these are some of the nuances that you typically don't have to think about when you're trading stocks that you do have to worry about when you're trading options. So before I had an example, and I think these types of spreads are pretty common, where you see something that trades at 775 by 795. That's about a 20-cent spread. I think 10 to 20 cents is a pretty common spread that you see when you're trading options, which means that you have a midpoint of 785. So the question is, where do you place your orders with respect to that midpoint? I say most executions are executed within 5 to 10 cents of that midpoint, but it depends on whether you're buying or selling. So if you're buying, you always want to place your limit orders between that midpoint and the ask price. If you're selling, you want to place your orders between the midpoint and the bid price. So remember that when you're trading these types of options, if you're buying, you want to be in between these two prices. If you're selling, you want to be in between these two prices. And you always want to work off of that midpoint. So if you're thinking about buying that option, you want to go about 5 to 10 cents above this mid price. If you're selling, you want to go 5 to 10 cents below that mid price. So if I was buying a call option on this specific option that I'm looking at here, I would think about placing a buy to open order at roughly $7.90, because $7.90 is 5 cents away from the midpoint. 785 plus 5 cents, that's $7.90. That's how I would go about determining where to place my orders to buy on this specific spread or this specific option. And if I was trying to sell this call option, let's say I was selling a cover call or I was selling a put here, I would go 5 cents off of the 585. So I would take 5 cents off 585. So I would enter a sell to open order at, let's say, $7.80. So I always start about 5 to 10 cents away from the midpoint, depending on whether you're buying or selling. You either add to the midpoint or subtract from the midpoint. So the rule of thumb here is to remember that if you're buying, you want to add to that midpoint price. If you're selling, you want to subtract from that midpoint price. So that's, those are the mechanics for entering an order. Those, like I said, there's a lot of things that you have to think about. And I think sometimes as experienced traders, we take some of this for granted. So for those of you that are brand new, I hope that this was a comprehensive look at all the different parameters that you have to look at when you're trading an option and how to enter those orders. Everything from making sure that you use to open and to close orders correctly, making sure that you have all the parameters correctly, and more importantly, from a limit price where to start your order limit price. Now, what I will say is that if you do place a limit order at, let's say, $7.90, and it just sits there and it's not really getting filled, that's when you might want to increase it to, let's say, $7.95. That's where you can, the further you go in terms of closer to the ask price, the higher the probability of you getting filled. The closer you are to the midpoint, the lower the probability of you getting filled. So you want to play around, but like I said, you always want to start about 5 to 10 cents away from that midpoint, depending on the size of that spread. So when this spread here is only 10 cents, I would start 5 cents away. That's usually always a good starting point for entering these types of orders. So now that we've talked about entering these trades and how to get yourself in them, let's talk a little bit about managing these trades. So this is where I'm going to break down different option strategies and to talk about how to manage them. So first, I'll talk about two of the most popular strategies that we talk about here, which is respect to option selling. Because managing trades, I would say, is a little different depending on whether you're selling an option or if you're buying an option. So first, we're going to cover selling options. So either selling a cover call or selling a cash secured put. So when you're selling a cash secured put, this, from my perspective, is a really easy strategy to manage, because cash secured puts are a strategy for trying to acquire stocks that you want to purchase at a discount. And when you're selling a cash secured put, there's really only two possible outcomes, both of which do not require active management. If you sell a cash secured put and that put expires worthless, you simply rinse and repeat. Meaning if you sell a put and the stock doesn't go below that strike price, you would go and try to sell that put again and try to generate more income. So that, in my opinion, is a pretty straightforward example. If you do sell the put and the stock goes below the strike price, that's where you now own the stock at the strike price minus the premium that you received. So those are your only two outcomes. There's really not much that you need to do to manage them. These are both, I mean, selling a cash secured put is a strategy that doesn't require management before expiration. It either expires worthless or you end up owning the stock. Those are your two possibilities. So it's really straightforward. On the other hand, once you own that stock and you start selling covered calls, this is a strategy that allows you to generate yield on the assets that you own. So think of the stocks that you own as assets that you own, and covered calls allow you to generate yield on those assets. So when you sell a covered call, there are effectively three possible scenarios that will come about when you sell a covered call. Number one, the stock can go significantly higher above your strike price. Number two, the stock can simply move sideways. Number three, the stock can move significantly lower. And this is really where you have quite a few different options. So I think first I want to address what happens if the stock moves significantly higher, because this is really where we tend to see some users panic because you have an unrealized loss on that short call that you've sold against the stock that you own, and you're not sure what to do. And the rule of thumb here for whenever you're selling a covered call and the stock goes above its strike price prior to expiration is to simply hold on to that covered call until the last week of expiration before you try to do anything. And I know sometimes that's difficult when you see that large unrealized loss, but the best thing to do is to hold on to that trade, wait until the last week. And once you are in that last week, you can then choose between the two options. Either buy back that call because you don't want to lose the stock and sell another call, which is what we call a roll, or you can simply let the stock become exercised and sell the stock at the strike price. Those are your two options. But if you are going to do either one of those two options, you want to wait until the last week before you do that. In the event that the stock moves sideways, this is really where the call will expire worthless and you want to rinse and repeat. You want to generate an additional income stream, or you want to generate a consistent income stream for the assets that you own. And if the stock moves sideways, that would be, in my opinion, your best case scenario. Lastly, if the stock moves significantly lower after you sell a cover call, that's really where it's the only time to make sense to do something early. All the other two events, you do nothing until the last week. If the stock moves significantly lower, this is where you might want to buy back the call that you've sold. If you're able to do so at 20% of the premium that you originally collected, which means that if you sold a cover call for $1 and it's now worth 20 cents or less, that's when it makes sense to buy back that call, take the 80-cent profit that you've made, and especially if it still has a few weeks left to expiration, and sell another call immediately. That is the only time, in my opinion, that it makes sense to do anything early with respect to a cover call. So that is something that I do cover specifically in both the cash secured put and the cover call webinars. So if you want to learn more about these strategies and you want to learn more about managing them, please take the time to take a look at some of those webinars. Next, I want to talk a little bit about credit spreads. Now, the reason I'm jumping straight to credit spreads is because this is one of those strategies where when we talk about managing trades, we're talking about both cutting losses and we're talking about taking profits. And credit spreads, because of the nature of credit spreads, where effectively credit spreads are one of two trades. Either you feel that the stock is near a resistance level. So let's just do a quick drawing here. Let's say the stock is near a resistance level and you believe that this stock is not going to continue moving any higher. That's when you want to sell a call credit spread that basically says that I don't think the stock is going to go above that strike price, and I think it's going to bounce lower. Conversely, to sell a put credit spread, that's when you have a floor of a stock and you simply feel that the stock is not going to move below that floor. So you have a stock that's trading around the floor, and you basically believe that this stock has reached this floor and it will bounce higher. So in both of these cases, because you're effectively defending either a support or resistance level, the outcome of this trade is either you're correct and the stock does not go above this resistance level and just bounces lower, or you're completely wrong and the stock breaks right through those levels. So from my perspective, this is a trade that you basically have pre-planned prior to the trade. Either you're correct and you get to make a profit, or you're wrong and you take a loss. There's really no in-betweens here. There's really no, okay, I need a little bit more time, or my targets have changed, because the support and resistance level from this perspective really shouldn't change. You either break that support or resistance level or it doesn't. So the rules for managing credit spreads, in my opinion, are pretty clear cut. There isn't a lot of leeway. There isn't a lot of subjectivity in managing these trades. These trades, you want to enter and exit them when you expect a market top or bottom. So when we talk about those support or resistance levels, those are the ideal times to enter selling a credit spread. For those of you that are brand new to this strategy, I have a whole webinar just explaining what a credit spread is. So if you're not familiar with this, I highly recommend you to take a look at this. But generally speaking, once you've sold your credit spread, the goal is to let this credit spread expire worthless and for you to keep the credit. But we do find that many times, if you are timing your credit spreads well, you will make more than 50% gains with more than half the time left to expiration. And that's one of the reasons, and that's one of the times when you want to take profit early, is when you've reached 50% gains and you still have more than half the amount of time left to expiration. On the flip side, if the trade is moving against you, this really depends on the amount of credit that you receive. So there are lots of different credit spreads that you can trade, unfortunately. The credit spreads that we usually teach is that the credit that you receive is at least more than a third of the width, is roughly a third of the width of the spread. But some people like to trade those really high probability trades. So if you follow the methodologies that we show you, you want to cut your losses where you've lost anywhere from 75 to 100% of the premium that you've received. So if you're collecting $1 and you're now down $1 on that specific trade, it's about time to cut your losses. However, for those of you that do trade those higher probability trades where you are receiving a relatively small piece of the width of the credit as a credit, that's where you want to cut your losses anywhere from 100 to 200% loss of the premium that you receive. Now, again, like I said, the credit spreads are a more advanced strategy. So I'm not sure how many of you here on this webinar trade credit spreads. If you want to learn more about credit spreads, I do have a whole webinar just on that alone. We have a whole separate service that just shows users signals on how to trade credit spreads. So I recommend that if you want to learn more about the strategy, to take a look at those webinars and our our service on selling credit spreads. So let's go ahead and move on. Now let's talk about long calls and debit spreads. And the reason I'm talking about this strategy last is because this is one of the few strategies that may make sense where you do things beyond just the trade itself. So, a lot of times when we're buying a call option or buying a debit spread, we have a directional view on the underlying stock. So this is the strategy where we're buying the options. In the last two strategies that we talked about, selling cash secured puts, selling cover calls, selling credit spreads, those are all option selling strategies. So the rules for managing them, generally speaking, are pretty clear cut. You're either right on the trade or you're wrong on the trade, and they have predefined risks and rewards that you generally should be comfortable with prior to getting into that trade, and you accept either being right or wrong and taking a profit or cutting a loss. When it comes to buying options, that's where things can be a little muddier. Depending on where the stock goes, depending on your directional view. So this is really where risk management is absolutely key when you're buying long calls and debit spreads. Now, the rules for this type of strategy, generally speaking, is very easy as far as cutting losses, because for all long calls and puts and debit spreads, you generally want to cut losses whenever you've lost 50% of what you've paid for the option. So if you purchase a call option or a debit spread for $1 and it's now trading at 50 cents or less, it's time to cut your losses and move on. Because if you've lost more than 50% of a long option trade, that means the trade has started to go against you. And that means that the stock has not moved in the direction that you expect it to. That's when you will typically see these types of losses. And at that point, once you've lost 50% of a long call option or a long debit spread, your chances of coming back or being profitable on that trade is very, very low. Unless there's some kind of catalyst like earnings or news or something like that, your chances of making money on that trade are fairly low. So it's always best to cut losses, maintain that rest of the trade, maintain the other half of the trade that you still have on, and take that capital and put it towards another trade. So my rule of thumb here for these types of trades is never, ever double down and increase your portfolio risk. A lot of times someone will buy a debit spread or buy a call option. They start losing money on that trade. And I get the question of saying, hey, this trade's gone against me. What do you think about me buying some more calls? And my answer always is, if you weren't already in a losing trade, would you buy another call right now? And 9 out of 10 times that answer is no. And that's really the reason why you shouldn't double down and add more risk to a already losing trade. On the flip side, you want to start taking profits on these trades, usually between 75 to 100% gain. Now, I will say that in the recent market environment where volatility has been very, very low, we have had to shift this number a little bit. We've had to shift this number a little lower. We've been finding ourselves having to take profits somewhere between 50 to 75% as opposed to 75 to 100%. So these are some of the things that we've been adjusting for lately. Based on the current market environment. And these things are quite dynamic because market volatility can easily come back very quickly. And we've seen some of this shift in the current earnings season. Volatility has kind of picked up a little. So we tend to oscillate between this 50 to 75 and 75 to 100, depending on market conditions. So currently volatility is relatively low. So we are taking profits relatively early, especially when markets are quite overextended right now. A lot of our long trades, we want to start protecting profits early. And those are some of the things I want to talk about here today is managing these trades, meaning how do you take partial profits when possible? How do you roll your positions up and out when your targets are extended in either in time or in magnitude? So when we talk about rolling strategies, when we talk about modifying a strategy, these are really only for when things go in your favor. This is not something to do when your things are going against you, because the rule of thumb is when things are going against you, you should just simply cut losses and move on. You should not be trying to repair a trade and add more risk to it. Anything that you're doing with respect to rolling, with modifying the existing trade should really be when you have changes in the target because the target price is now extended or the target price that you have needs more time to reach them. That's the only time when you want to roll a position. Now, I'm going to go through a few different rolls that make sense for when things go in your favor, but maybe you need a little bit more time, or maybe you think the stock's going to continue going in that direction that you expect it to even further. What can you do to protect your profits, take partial profits, and reduce your overall risk? So when I refer to the term roll, I get a lot of questions from users saying, what is a roll? A roll is simply where you close your existing option position that you have and you open a new position in a single order. And the key here is doing it in a single order. So if you have already a call option and you're simply closing out that call option to open up a new call option and you're doing that in a single order, that's what we refer to as a roll strategy. So it's nothing complicated. It's simply just closing out an existing position and opening a new one in a single order. So let's explore the different scenarios as to when it makes sense to roll a position. So first of all, I think the primary time it makes sense to roll a position, and actually in reality, this is actually not a roll. It's not a pure roll because you're just simply closing a position, but this is a common scenario that many of us may find ourselves in, where the target price that we have on a stock that we have has not been met, but it has gone a little bit in our favor. What can we do to protect our profits and reduce our risk? Because if we can reduce our risk, that's how we're going to increase our profits. We can't force increased profits. The only way to increase profits is by reducing risk. So I have an example here where I bought 10 contracts of a 100 strike call for $3. which means that I've outlaid $3,000 for this trade. And I did this because I had a target price of this stock of 110. So I bought the stock's trading at $100. I buy 10 contracts of the at the money calls for $3. I paid $3,000 for it. I expect the stock to go to 110. But in a few weeks, I only get half that move. I get a modest move up to 105, and there's still a few weeks left to expiration. So I have not hit my target price, but the stock has gone in my favor. So what can you do? How can you reduce risk? How can you take partial profits? This is really where one of the ways you can do this is simply close out half the position. So I can sell 5 contracts of that same 100 strike call now. Let's say because that stock has moved from 100 to 105, that call option is worth $6 now instead of $3. So what I collect now is a $3,000 profit from this specific trade because I sell 5 contracts for $6,000. My profit is now $3,000 on it. What this means is that now I've closed out half the position for a partial profit, and I effectively keep the other half of my position for free because now I have no more additional risk because I've made back my money on selling my 6 call options for $3,000. I'm sorry, my 5 call options for $6 each now. So I've now collected $3,000 in debits, which offsets the $3,000 that I've paid for the original 10 contracts. So now I'm able to keep half my position so that I still think the stock might reach 110. It just hasn't reached it now. But now I'm able to effectively take that bet that the stock will still reach that 110 without risking a single dollar on this specific trade. Now, the only requirement for this type of roll strategy is that you need at least a few weeks left, meaning if you only have a few days left, this is not a strategy that makes a lot of sense because you're effectively locking in, you are certainly taking on no risk, but you really have very little upside as well. So this really only makes sense is that if you have a few weeks left, you can take partial profits on the trade that you've made. This allows you to maintain half that position with virtually zero risk. Now, sometimes you may not be able to sell your trade for $3,000. You might only be able to sell those 5 contracts maybe for $2,000, but still you're reducing your overall trade now from $3,000 down to just $1,000. So if the stock does still take off, your payoff on that trade is substantially higher because instead of risking $3,000 on that trade, you've only risked $1,000. So even if you only make $1,000 on that trade, originally you would have only made a 33% return. Now you've made a 100% return because you've reduced your risk from $3,000 down to $1,000. So that is one of the key ways and one of the easy ways to allow you to increase your returns while reducing your risk when a trade goes in your favor, but it doesn't quite go far enough. Next, what I want to talk about is when you get that same type of move, but perhaps you need a little bit more time. And I think a lot of us find ourselves in this position where we expect a move to happen. The move materializes a little, but we're a little short on time. Maybe we only have 2 weeks left to expiration, but we think that it's going to take a little bit more time before that happens. Maybe there's another catalyst that's coming up, maybe a news event or a product launch, or maybe an earnings date that we need more time. We still think that profit target is going to be met, but we need a month or 2 extra. And I think this is a common position that some of us find in. So I have very similar position here. So I'm bullish on a stock trading at $100. So I buy 10 contracts of that same 100 strike call for $3. This cost me $3,000. I have a target price of 110. So let's say a few weeks later that I get this modest directional move up to 105. I still have 3 weeks left to expiration, but maybe there's a news announcement coming out 6 weeks from now, and I need more time, and it just doesn't seem to have the catalyst to move to 110 that I expect it to. What can you do? One of the things that you can do is simply at the time that now that the stock has moved up to 105, what you can do is you can now sell the whole calls, all of the calls that you've purchased. So I've purchased 10 contracts of the August 100 calls for $3. Because the stock has moved up to 105, those calls may now be worth roughly $6 or so. So I sell all 10 contracts of the August 100 strike calls for $6. For that, I receive $6,000 in credit, so which is effectively 100% return on my trade. But what I do, because I need more time, I can now go out and buy a September call. So I'm going to buy a call 1 month further out in time. Now, because the September calls are going to cost more, is going to be more expensive because I'm going out 1 more month in time, what I'm going to do is instead of buying 10 contracts of the September calls, I'm only going to buy 8 contracts of the September calls because they're more expensive. But notice that I'm able to do it for roughly the same amount of money that I received on the debit for selling those 10 August calls. And what this allows me to do is effectively finance a whole nother month for free. I'm still going to keep my original $3,000 profit. I'm actually going to reduce my risk a little because here I've gained $600 in credits, but I've only paid $5,600. So I've reduced my overall risk on this trade from $3,000 down to about $2,600. But what I've done now is by not only have I reduced my risk, I've now bought myself another month in time. So what this achieves an extension in time to reach the target price that I expected to with a little bit more time. But just keep in mind that because I traded in 10 contracts of the August calls for 8 contracts of the September calls, I do get a slight decrease in leverage. So I have a reduced position sizing. So buying yourself more time, you can do it without paying any more money, just that you're going to reduce the amount of leverage that you have. And when you do so, your downside risks, generally speaking, may be reduced as well. And generally speaking, you don't want to make this type of trade where you're increasing your risk. You only want to buy the number of contracts where you're either even on the trade or you're slightly under the credits that you receive. So here I've chosen 8 contracts because that's just under the $6,000 that I received. I wouldn't want to buy 9 contracts because I have to spend more than the $6,000 that I'm receiving by selling those 10 August contracts. So you can adjust the number of calls that you purchase in September based on the amount of credit that you receive. So let's say you only receive $5,000 by selling these August calls, then you might want to only purchase 7 contracts of the September 100 calls. And that is effectively a net credit here because you're going to get more on selling these than what you purchased in the September calls. Lastly, in the last example, what I'm going to go over is what if you have a price target that's raised? So this is the last example. Again, these roll strategies are for when things go in your favor. Keep that in mind. That is really, again, the only time where it makes sense to modify a trade. When things go against you, the rule of thumb, generally speaking, is to cut your losses and move on, because any of these roll strategies, when things are going against you, typically do not work out as well. You do have to put on more risk to trade that, and you never want to add more risk to a losing trade. So in the last example, I have same example. I'm long 10 contracts of the 100 strike call, which are $3, which means I have to spend $3,000 on it. I have the same price target of 110. In this particular scenario, I get a very quick directional move to, let's say, 107, and there's still a lot of time left to go. So I get the quick move, doesn't quite hit my target price, and I still have a lot of time to go. So this might be maybe an earnings trade that you make, where some kind of catalyst that you didn't really expect happened, that quickly moves the stock in the direction that you expected to, where now you actually think that instead of thinking that this stock will go to 110, you now think the stock is going to go to 120. What can you do? So here, what we're advocating is you still want to sell those 10 contracts of the calls that you purchased. Let's say these calls are now worth $10. So now you're able to sell this for a $10,000 credit. What you want to do instead now is you want to buy 15 contracts of a 110 call. So what you want to do is you want to roll these up. So instead of just, you sell the 100 strike calls, now what you want to do is you want to buy more of the 110 calls. Because the 110 calls are going to be cheaper, you're going to receive a $10,000 credit by selling these 10 original calls. You're going to spend $7,500 to buy these new calls. And what this does is it creates a net credit of $2,500, which means that you reduce your overall risk from $3,000 down to just $500 because you've received a $2,500 credit. Now what you're able to do is you're able to maintain that same long exposure with lower risk. And what you've done is you've increased your leverage, because instead of owning 10 calls, you now own 15 calls. So you've increased your leverage from, let's say, 10 to 1 to 15 to 1. And your downside risks may be reduced, because instead of now risking $3,000 on this trade, you're now risking a total of only $500. So you're basically financing a highly leveraged trade to the upside for a fraction of the original risk that you've wanted to trade. And this is all, as an alternative to simply just taking profit on your trade and closing out your trade at a profit, and simply closing out your trade, because for various reasons you may want to maintain exposure in the stock, whether the stock goes in your favor and more than you expect it to, and you want to lock in profits and continue to maintain that exposure. The key here is that you want to maintain exposure, but you don't want to put yourself at more risk, and you want to reduce your risk while you maintain that same exposure. Because I think a lot of us find ourselves in this position where maybe a trade goes in your favor a lot quicker than you expected to, and you're thinking, well, I can make more money, but I don't want to lose out on these profits. What happens if the stock drops? Because that happens sometimes quite often too. So you have $100 stock, it quickly shoots. You have $100 stock, quickly shoots up to 107, and you're not sure what to do. Do I take profits because you're concerned? What happens if the stock pulls right back and I lose everything? This is one way to protect those profits, but still maintain exposure to the upside, so that if it does continue going, you not only actually still have upside, you actually have more upside. But in the event that the stock does pull back, your risk goes from $3,000 down to just, let's say, $500. And this is really how you can take these types of bullish exposures or bearish exposures and limit your risk in the long run. So those are some of the strategies that you can utilize to maintain exposure, but reduce your overall risk once something starts to go in your favor. So with that, what I want to do is just thank everyone for taking the time out here this afternoon. I went a little bit over my allocated time, but I hope that I was able to cover a lot of material here today that helps you better understand how to go about placing your option orders and what are your options for managing an existing position. So like I said, again, when you're managing these positions, it's really important to know that when things go against you, it's best to cut losses and move on. When things go in your favor, there are quite a few rolling strategies that you can to protect your profits so that you can maintain that exposure, but at a much lower risk than you originally opened those trades for. So with that, I want to thank Arun for taking the time out here this afternoon. I just want to remind everyone, if you haven't signed up for Options Play, you can sign up using the link that's here on your screen that I just put into the chat window. If you have any questions, and I hope many of you do, it looks like there's quite a few of you that have already submitted questions while I was talking, please type them into the chat window or the Q&A window at the bottom of your screen, and I will answer as many questions as I have time for here today. So let's take a look. Let's scroll up. Looks like there's a lot of questions already that were submitted when I was speaking. James is asking, can also be an open to sell, which can be confusing at the opening? Sell to open, I mean? Yes, absolutely. You can sell to open. So any cover call, any cash secured put, those will be a sell to open because you have to sell those strategies and you have to open them to enter those trades. So absolutely, you absolutely have sell to open trades, especially cover calls and cash secured puts. Those are the sell to open strategies. Ram is saying, how about stop orders? Stop orders work the same way as limit orders. So that's just the type of order, because stop orders, are guarantee execution but not price. Limit orders guarantee price but not execution. James is asking, who fills your order? A human, a market maker, or a computer? Great question, James. It depends on your broker, but I would say 99% of option orders are filled by a computer algorithm. That's really how you get instantaneous fills for the most part. I don't know that there are a lot of human interactions, especially with retail type orders. If you're trying to, fill an order for 10,000 contracts, then yes, likely a human may get involved in that. But for most retail orders under 100 contracts, those are almost all filled by a computer. Ferdinand's asking, why do you not always enter an option order at the mid price? Very good question, Ferdinand. The answer is really because if you enter your order at a mid price, chances are it'll just sit there. You certainly absolutely can. If you enter this buy to open order at 785, it will simply just sit there, and you will basically wait for the market to move until that 785 is about 5 cents away from that midpoint before you actually get filled. So it's just a matter of how long you're willing to wait. So like I said, the further away you are from the midpoint, the higher the chance of you getting filled instantaneously. The closer you are to the midpoint, or if you're at the midpoint, the lower the chances of being filled. So the question really just becomes how badly do you want this order to be filled? Do you want it to be filled very quickly, or are you okay waiting for the markets to move before your orders are filled? But if you put them at the midpoint, it will most likely just sit there. Keith is saying, why not enter the midpoint first to see if you can get the best price, then adjust over time to see if it's not filled? Same question, Keith. Great question. You absolutely can. From my experience, placing at that midpoint, there's almost zero chance of you getting filled, which means that you'll likely going to have to move it from that midpoint anyway. So we usually start just a few cents off that midpoint as a starting point. Pablo is saying, not easy, kind of scary. I don't want to be stuck holding stock. So I'm not sure what Pablo means. Oh, if you're talking about cash secured puts, well, then cash secured puts is only for stocks that you want to own. So you wouldn't even find yourself selling cash secured puts on a stock that you don't want to own, Pablo. James is saying, Tom Sosnoff preaches closing an open option when you have 50% profit based on extensive tasty trades backtesting analysis. So I think that I said the exact same thing, but I believe those are for specific types of strategies, which is specifically for option selling strategies, and I would tend to agree with that as well. When targets have been extended in time or magnitude, news or analyst rating, or what? Yeah, so there could be various reasons that you may have to extend your time or magnitude. Many times it's usually a catalyst. So whether it's a news announcement, typically news announcements are I think, where something fundamentally changes between the time you enter a trade and the expiration date, where I would say you reevaluate your outlook on the underlying stock. That is when you will find yourself either changing your targets or changing your time frame. Is this recorded? Yes, all of our webinars are recorded, and you'll be able to get access to a recording with the slides in about 30 minutes after we finish here today. Keith is saying, in that example, I'd sell the 10 contracts for $6 and close out at a $100 profit. And you're absolutely right, Keith. And I think Keith was referring to this specific strategy where he would sell it for a 100% profit. And you absolutely can sell that for a $100 profit. But many times you might want to maintain exposure. So here's a way to maintain exposure, a longer exposure without putting an additional risk on it. So the key here is to buy yourself more time without adding more risk. You absolutely can take your profits and move on, but sometimes you just want to maintain exposure. And maybe you don't have to buy 8 contracts of the September calls. Maybe you could just buy 4 contracts or 5 contracts, and basically bring yourself down to 0 risk, and basically buy yourself another month and have 0 risk to do so. So there's many ways that you can play around with this, but these are just examples to show you what is even possible with rolling a position that allows you to continue to maintain exposure while either reducing or completely removing your risk, or at least not adding on more risk to maintain the exposure that you want. Adjustments, repairs of option strategies will be a good webinar. Ram, again, you can differ on my philosophy, and I think some people do, and everyone's entitled to this, but my philosophy is to never double down and increase portfolio risk on a losing trade. So yes, there are some repair trades that I've seen and heard of and learned about, but for the most part, those repair trades at best get you just back to break even, which means that you're typically taking on more risk just to try to get back to break even. I'm not a big fan of those. I'd rather just simply cut my losses and move on. I can accept the fact that my initial analysis is wrong. Trying to throw good money after bad money is never a good strategy. And I've seen lots of traders lose their shirt doing these types of repair trades, because a repair trade can also go wrong and you end up trying to repair that. Next thing you know, you've risked a lot more money than you originally intended on, where if you simply just let that first trade go, you would have been perfectly fine and just moved on to the next trade. So that's my philosophy with trading, and I think that it tends to make trading a little easier to manage versus if you're constantly trying to manage all these losers and trying to make it so that you never lose. You just end up with a lot of trades that you never intended on trying to be in and trying to manage them, and it becomes a headache to do so. So that's just my philosophy on trading. And if you want to do repair trades, there are a few that I've heard of that may work, but I've never actually traded any of them myself, I will be honest. Matthew, you're very welcome. I hope that these rolling strategies are useful. Val, same thing. Thank you so much. Spencer, never thought about these rolling strategies, could have used them. I'm glad that I'm able to kind of impart some of this knowledge on those of you that do find yourself in these positions that think you could use them. Ron is saying, when selling cover calls, if stock is above strike price, hold until last week of expiration is a risk if the stock goes ex-dividend prior to expiration date. Ron, you're absolutely right. However, that generally speaking is only true in the last week before expiration. The dividend risk is really there when the extrinsic value is very low, and that tends to happen in the last week before expiration. So you're absolutely right, but again, that risk generally is only in that last week as well. Jose, JT, thank you so much. I really appreciate it. JT saying, how about stops? Can you set stops in options trading? Absolutely. You absolutely can set stops in options trading. Just keep in mind, stop orders guarantee you execution, but do not guarantee you price. So you can set a stop order to sell your option at 50 cents and find yourself filled at 10 cents, significantly below your stop price. So just keep that in mind. Ro is asking, when would selling the 110 for $5 instead of rolling or closing? $3 debit, $5 minus. Ro, first of all, I think you're referring to this specific example, and you're saying when would selling the 10 for $5 instead of rolling or closing? So this is really when you have a target price that has changed significantly. So maybe you were originally long the stock, you think it would go up to 110, but maybe some news announcement came out and it quickly moved to 107, and now you think the stock can go to 120. That's really when you want to use this type of strategy that I have here, which basically allows you to take profit, buy more options at a higher strike price for a cheaper valuation or a cheaper debit, and effectively buy more upside with more leverage and at the same time reduce your overall risk on the trade. Sue is saying, why sometimes placed orders never get filled? Well, that depends on where you place your orders, and that's part of what I'm saying is that you want to start out on the midpoint, about 5 to 10 cents away from the midpoint, and work your way out to the asking price. If you really want to get filled, you can always just place an order at the asking price or place a market order. If you really need to get filled, place a market order, test it out with 1 or 2 contracts at a time before you decide to place a market order for the entire option contracts. Jose is saying, I found that if I entered at 785 in this example on some platform, it raises the bid and the offer. So that's the machine algorithms on the back end, and you're absolutely right. But again, don't worry about what the machines are trying to do to outsmart each other, because it doesn't matter what they quote on the screens. Market makers have their own theoretical values that they're willing to fill an order at. As long as you are spreading it above that theoretical order by a certain amount, they will fill it. So don't worry about what the other machines are doing to try to outsmart each other. What you're talking about are the algorithms on the back end that market makers will do to try to pick off each other. But that you can ignore that noise, from my opinion. James is asking, natural price, how is that different from the mid price? The natural price is the ask and the bid price. That's what we refer to the natural price. So when you hear about some platforms that call the natural price, that's the bid ask price, versus the mid price is the middle of the natural price. So I hope that answers your question. Keith, you're very welcome. Thank you so much. Thank you, Tony. Who's your broker and why do you stay with them? Price or services and products they offer. I trade with Thinkorswim or TD Ameritrade. I've been with them for over a decade. The price for them is certainly more expensive than I think many of the discount brokers out there. But the reason I trade with them is because of the order execution that I get at TD Ameritrade, in my opinion, is on par with any discount broker. So you have to consider the fact that you have to manage executions versus pricing, because a lot of people are saying, oh, I don't want to pay $10 on a trade. But if you think about it, a single penny on an option trade on 10 lots is $10. So if you're getting even a penny price improvement at your broker, that's easily worth the $10 commissions that you're paying at that broker. So many times I find myself at TD Ameritrade getting price improvements of 5-7 cents many times. And if you think about it, on a 10 contract trade, that's $50 to $70. So I'm gladly to pay my $10 to my broker, if you will, if they're getting me good executions. Now, the thing about executions is that it's almost impossible to compare executions from one broker to another unless you trade two trades at the exact same time. And those are some of the things that I have tested with some folks, is trying to trade the same contracts at different brokers and seeing what type of executions I get. And I'm very happy with the executions I get at TD Ameritrade, and that's who I choose to trade with. Regarding the fact of many try to fix a bad trade, there are always another trade tomorrow. Absolutely right. I just prefer to not have to deal with the headache of trying to repair a losing trade. When I enter a trade, I'm prepared to take that loss. If the trade doesn't work out, I take that loss and I move on. Under what conditions would you actually exercise a call option? From my perspective, I wouldn't ever. I would always close out that trade prior to expiration. So whenever you're long a call or a debit spread, I always close that out prior to expiration. Wow, a lot of questions here today. Thank you so much, guys. What is a good strike price for secured put or cover call and credit spread? Andy, great question. I actually have a whole webinar just on that alone. So I highly recommend you to take a look at that. If you go to our YouTube channel, we have a whole webinar just on the top 3 strategies to generate income. I recommend you to take a look at that webinar because that will allow you to learn about these 3 strategies and what are the best practices. So I just posted both the link to the whole webinar series as well as the link to that just to that one webinar. If you want to learn more about those 3 strategies. John is asking, if 3 trades shown in options play, does the highest score usually the best purchase? So John, I wouldn't say it's the best purchase. It's the strategy with the best risk to reward ratio. That's how we think about these strategies. So the risk to reward ratio is one aspect of multiple things you have to look at. It is certainly one thing that I require on my trades, but there's a lot of other things that you should be considering. Is what is the direction of the stock? What strategy do you want to trade? What expirations and strike prices? The options play score is simply telling you the risk to reward or how cheap an option is. But a cheap option doesn't mean it's a good buy, because you only want to buy cheap calls if you're bullish on a stock. You don't want to buy cheap calls if something is bearish, if you're bearish on that stock. So just having good risk to reward ratio in itself is not a good reason to buy something. Raymond, thank you so much. Keith, I'm a member of one of your packages, the one that shows trades. How do I get into something that has classes? Well, I think what you have here right now is exactly what gives you the classes. These are the classes that we run that teach you how to trade these different strategies, and it's all available to you here with your Options Play subscription. Andy, these 3 strategies only works if we desire to own the stock. Andy, if you're referring to the 3 strategies on your screen, no, all of these strategies are for if you do not want to own the stock. So that's why we trade options many times, is because we don't want to touch the stock. Thank you, Molly. James, slippage, would an limit order prevent this? Yeah, because limit orders guarantee price. If anything, you get a price improvement on a limit order, so you won't have slippage. Slippage only applies to stop orders and market orders. Matthew, thank you so much. I appreciate it. See you next Thursday. Keith Keith is saying placing at the market can get pricey. So Keith, I will say when you trade at a major broker like TD Ameritrade, and I know how their orders are executed, and I know that market makers are competing for my order when I place my market order. Again, I do typically only trade fairly liquid names, so I'm not trading some obscure small cap names, which if you're placing a market order is very risky. But if you're trading things like Visa, MasterCard, Microsoft, Apple, any of these big names, and you place a market order, I know market makers are competing for my order. And many times I'm actually getting a better fill with a market order than I am with a limit order. And that's something, again, you're going to have to try for yourself at your broker. Each broker is different as to how they route their orders. But like I said, I can certainly vouch for the order routing at TD Ameritrade, and I know for a fact that many times I place a limit order at a specific price. It just sits there. I place a market order. I even get a better fill than the limit order that just sat there. Is a calendar spread only good for earnings calls? No, you can trade calendar spreads even without earnings. But generally speaking, I think a lot of traders that do trade calendar spreads tend to trade them around earnings. Alex is asking, have you used Tastyworks? I'm familiar with the platform. I've used their platform before. I haven't traded myself through that platform yet. I just opened an account recently to try things out. Because they are significantly cheaper, and I'm willing to, I'm fairly broker agnostic. I've just been with TD Ameritrade for over a decade. That's why I've been trading with them, but I'm always open to other platforms. Jose, do you have any videos on optimal use of Thinkorswim platform? Jose, Thinkorswim has a wealth of information on their platform. I would always tell you to go there. I mean, they are the experts of that platform, even though I've been trading on that platform for over a decade. I certainly think I know it well, but I think the people at TD Ameritrade know it better, and they do classes almost every single day on it. So I do think that the best resource for that is going to Thinkorswim. How to close out a vertical debit spread? Great question. So if you look at any position on our positions tab, so let's say you're looking at the eBay trade and you want to close it out, you can click on close position. And when you hit the trade button, we will also present to you exactly how to close out that position. So these are the order that you would enter to close out a position. And you can always click on a position management, close position. But if you want to know how to close a position, my best suggestion to you is call your broker, have them walk you through it, because each broker is a little different. Usually you just select a position from your positions tab, and you can usually have a option to simply close, and it will pre-fill a ticket for you. So that's usually the best way to close it, is just going to your positions, and you should have an option to close on your positions tab. JT is asking, I trade with E-Trade and they enter bid, mid, ask, and the last. What's the value of knowing the last? In my opinion, the last of an option trade is worthless, because the last could have been traded hours ago and really doesn't mean much. The last price, I think, is more so for if you're trading stocks, but almost completely useless for when you're trading options. You only want to use the bid and the mid ask as a reference point when you're entering an options order. Great question, JT. James, are there iceberg orders we do not see when looking at market depth windows? Absolutely. There's lots of things that you don't see on the screens. But that's what I'm saying, is don't look at the screens. Look at the midpoint, put in your orders about 5 to 10 cents away from the midpoint. Don't worry about what all the other big guys are trying to do to outsmart each other. It really has very little effect on you as a retail trader. That's what I'm hoping to instill to you guys. Ferdinand, I do my own transactions online, BMO. If the institution does not have the roll function available, I guess you'll have to close one transaction, open a new one, pay twice the fee. Ferdinand, can you enter multiple orders or multiple lines? If you can enter multiple lines, you should be able to have one order that's to open and one order that's to close. If that's not available, I can't help but think that you should move to a broker that does allow you to do that, so you don't have to pay twice the fee. Or I would call them up and say, hey, your technology doesn't support this. This is what I'd like to do. Can you waive the fee for me on one of the legs? That would be my suggestion to you. Keith, thank you so much. I'll see you next week. James, are there any websites or resources where you can find options that trade in pennies? Yeah, so there's a whole, you can go to the CBOE website and they have a penny pilot program. If you just search for penny pilot program, you can find out all the symbols that trade in pennies. So just search for penny pilot program. Is there a way to on Thinkorswim to see the P&L on multi-leg options trades? Yeah, so I will say you many times have to group them together. So I don't have a trade that I can let me see if I can simulate one for you. Show you what that looks like. I don't know if something will get filled after hours. So I use the Thinkorswim platform on my phone, and they do show you the combined P&L of multi-legs. I'm just trying to see if I can do it on the platform. Let's see, vertical. I don't know if this will let me do this. It's still a vertical, still a filled order. But you should be able to see your P&L open, which for an entire position. So if you have multiple legs, you should be able to see the P&L open of both legs when it's rolled up on that one line. So you have one line for each symbol, and you should be able to see the P&L open, which means that you can see the P&L of your total, whether you have a debit spread or 10 legs, whatever it is, you will have a combined P&L for that whole leg. Is Thinkorswim available in Canada? I believe there is a Thinkorswim available in Canada, but it might only be for U.S. Securities. Ro is saying, any way to change the defaults in order examples, buy shares, buy calls, buy debit spreads, to risk reversal of debit spreads? That's something that we're thinking about adding, is to allow you to enter your own customized strategies. However, we will probably limit the number of strategies because we want to also provide you with best practices for the expiration dates and strike prices. And there's obviously only so many strategies that we can do that for. So yes, thank you for the feedback, Ro. That's definitely something that we intend on adding to our platform. Irina, thank you so much. How to trade now and beyond? Great question. Beyond options are extremely expensive right now. So in my opinion, if you wanted to trade Beyond Meat, I highly recommend you to consider probably buying that stock. So, stock's trading at 222 right now. That 222 call, actually, these call options are really cheap. So I guess we'd have to see where this opens. I think the stock just, oh no, it didn't report earnings. It just shot up $20 today. So it's really, it's hard for me to say right now. I mean, these calls do look pretty cheap, these at the money calls, but look at that. That's a $22 premium on an at the money call in just 45 days. So the stock has to go about $22 higher just for you to break even. And I know that doesn't sound like a lot for a stock that's up $22 today or $20 today, but options are very, very expensive on this specific name. But these September calls actually look pretty cheap. As you can see, the options play score is 110 here. But I don't know if that's because of, it just closed weird on this specific stock. I would look at where this opens up tomorrow. Irina saying Fidelity also gives price improvement. Yep, pretty much any of the major brokers. If you trade at Fidelity, Schwab, TD Ameritrade, you're going to get price improvement on your trades. Also, one can ask for reduced pricing on trades. Absolutely. If you're an active options trader, you can always call up your broker and ask if they'll give you lower commissions. I've generally found that many brokers will do it, especially if you trade fairly actively. Harry, do you use level 3 data to get prices? No, we only use level 1. We only need level 1 because you're not actively trading options. You're not day trading options. Level 2 data is really for day traders that are trying to get trade size. If you're just trading a few contracts of options, you only need level 1 data. Explain how do you get trade into positions. So currently the trade is only we can enter those trades, but we are currently in the process of allowing you to enter your own positions as well as being able to pull your positions from your brokerage firm directly into options play. JG is saying, can I email a question about the platform? Absolutely. You can send us emails at info@optionsplay.com. I'll just put the link in the chat window. James, thank you so much. Great session as usual. Thank you so much for your participation as well. I appreciate you asking all these questions. It's been really helpful. Ferdinand, for your information, I just opened up a Thinkorswim account at TD Bank. They will set it up for you. So for those of you that are in Canada, it looks like it is available in Canada. On options play, how does one look for movers on the weekly options for the next day? So we have our trade ideas section, which is one of the ways that you can look for potential ideas. There's lots of different ways that people look for movers. I usually use the trade ideas. Those are based on technical scans. Many of you subscribe to other platforms like Chaikin Analytics to find ideas. I would say there's no shortage of ideas in our investment community, whether you use StockTwits or third-party service or even screeners yourself. Yes, sorry, info@optionsplay.com. Sorry, there was a typo there. So thank you so much, everyone, for all the questions. That was a great session, a phenomenal amount of questions here, and I hope I got to everyone's questions. I want to thank her for taking the time out here this afternoon. We went way over time here today, but I'm glad I'm able to answer so many questions. Sounds like a lot of people had questions that they needed answered. So I hope that this session was useful. Like I said, this was a bit of a departure from what we typically do. So this webinar is recorded, so I will send everyone both the recording and the slides. So if you're brand new to options trading, take the time to really, especially the first few slides where we talked about entering your options orders. Make sure that you follow those best practices so that you don't get screwed on your options orders, and I don't get more emails saying, hey, I screwed this up and now I have double the amount of positions that I originally intended to. I hope I never see those emails again. So good luck to everyone. Happy trading, and I'll see you guys next Thursday.